So I think that could be a stressful thing for the market going forward.
Thanks, Bruce. Pete, any additional thoughts?
Yeah, look, just picking up from where Bruce left off on interest rates, I think a year ago, the arbitrage for prime RMBS was very challenged, and the cuts in interest rates have helped issuers expand margin, and that's supported the supported tranches of those deals. But we too remain sort of cautious that as interest rates back up, that arbitrage again will be challenged. Albeit that spread compression that we've seen to date has certainly helped the market significantly. I think it's been interesting to see sort of the emergence of offshore investors who've been willing to invest in Australian dollars. To what extent that's due to the lack of product available in their home markets, or an acceptance of or an acceptance or an understanding of how they would hedge that back into their local currency on their own balance sheet, I'm not sure, but that's been encouraging, and a broader investor base and better liquidity, I think, is a good thing for our product in general. I guess the one thing that I think is yet to be resolved, certainly for the prime RMBS market, is rating agency methodology. I think there's one rating agency that stands out in rating the sub-tranches of all deals, and I'd be lying if I wasn't a little uneasy about that, particularly given there's some pressure on Genworth to, I guess, IPO at some point, and their rating is somewhat contingent on that. So that's one thing that sort of keeps me awake. But all things considered, a pretty good year, and a pretty healthy market currently.
Thanks, Pete. Tim?
Yeah, just picking up on Pete's theme about an overall healthy market, I think one of the standouts for this year has been the level of RMBS volume is significantly ahead of where it was for 2012. This year we've had nearly 25 billion of new primary issuance, whereas last year that number, for the full year was only 10 billion. So there's been a big switch between covered bond issuance, which predominated a lot of last year, through to prime RMBS issuance this year. I think some of the other encouraging signs for the market, we're seeing new and less frequent issuers come to the market this year. A couple that we could point out there are obviously AFG issuing for the first time at the beginning of the year, P&N Bank. So a number of these issuers who are either first time or who may not have been able to issue at attractive levels in the more challenging environment. So I think, again, that's supportive for the current state of the market. We're seeing a slight lengthening in WALs, which probably hurts us in terms of the spread that we can generate when we invest, but overall it's got to be a positive thing for the issuers. And I think if you look through the recent post or taper related volatility, RMBS generally performed pretty well. I think there might have been circa 20 basis points of widening right around the peak of the volatility, but a lot of that is subsequently unwound. So I think and importantly, issuers were still able to access the market during that period. So I think there's a number of positives there. On the ABS side, the volumes are relatively flat compared with last year, and I guess that's a little bit of a disappointment for us. We view ABS as being attractive from providing diversity of issuer, diversity of structure and diversity of collateral into the book. But that said, the positives are that if you look across the ABS space, there's been a number of, the diversity of the issuers who have actually come has been very encouraging.
Thanks, Tim. Patrick, your thoughts?
We still remain very positive for the asset class. We believe it's great value compared to other RMBS globally, as well as other credit asset classes. So I still think the asset class actually in what I do, which is go out and speak to a number of international investors and discuss the merits of the asset class and investing in it, is still quite tainted. There's still a very negative view on the Aussie residential property market. There still seems to be a bit of a stigma over the liquidity, which is true. It is a very illiquid asset class. But I think if you price the structure around that, the returns are compelling. And as we talked about, the volatility during that June and July period, which some of the other competing asset classes was horrific, not to mention the emerging market asset class. I think that the macro factors are still very, very supportive. Now, that's obviously dependent on what your view is on the macro factors. We think the positives, overlay or are greater than the negatives, and house prices continue to show strong signs of appreciation. Interest rates are historically low and remain low, and we think that they will remain low through 2014. We, of course, stress test for rising interest rates, no different to anyone else, on all new deals and deals that we have in the portfolio. And our worst case scenarios, the assets seem to perform pretty well in a credit default scenario. So I think the asset class still has significant merit. We do believe the domestic economy is showing some early signs of adjustment to the wind down in the capital expenditure and future intentions of expenditure in the mining and the energy sector. And this is obviously seen through the lower rates and I guess the lower currency, which the RBA has been jawboning. We do, however, believe unemployment is going to continue to drift higher through 2014. We're targeting 6.25%, 6.5%, but believe the assets that we own are well structured, have solid underwriting fundamentals and have sufficient subordination for this trend in rising unemployment. Now, as we talked about, issuance is obviously at post-crisis highs, and I think this is bringing new investors domestically and internationally, and the more people we have analysing and investing in the asset class, the more liquidity it's going to bring, which we believe is still one of the major overhangs of the asset class, and has been discussed a lot on the different panels. The negatives that keep us up at night is obviously global macro trends, and Janet Yellen is going to talk tomorrow night, and everyone is hanging on her words. And what does tapering mean, and what effect is that going to have on the mark-to-market of assets and portfolios and credit assets globally? The moves in June and July, as we talked, were pretty frightening. I mean, some emerging market assets moved 30 points, 30%, which is a pretty compelling reason why you want to reconsider some of those assets. So we're positive. And I guess another negative is probably competition and underwriting. Underwriting volumes in the non-bank sector have really picked up significantly in the past 12 months. Now, whether this is a function of the majors dragging their feet repricing or overall credit growth being sluggish, but perhaps it may be around subtle changes to underwriting standards, and that does concern us. So, we believe post-GFC, some of the underwriting vintages that we invest in now are as good as it gets, so it can only really probably deteriorate. So we watch closely how new pools are brought to the market, what percentage investment property, LTV, geographical concentration, so on, what everyone else in this room looks at. But one of the areas that we do look closely at is the Australian dollar and its effect on the economy, and we watch the RBA very closely in terms of how concerned they are on that and the volatility of that. So, net, we're positive.
Thanks for that. I'm picking up on some of those themes about, trends in the underlying credit performance. And one of the other hot topics that's been discussed over the course of the conference, the RBA reporting requirements. We've heard offshore investors and some service providers talk about some of those developments, what it means for them. It'd be great to get an idea from domestic investors who are obviously at the sophisticated end of the spectrum as far as credit analysis is concerned, on your thoughts on that initiative. What are the benefits that you see from the program? Are there things that aren't being covered in that process that you'd like to see covered, and are there things in there that should be changed? And just maybe as a follow-up question, if you've got any specific thoughts on it, whether or not you expect to see development of a market for issuers that plan not to get repo eligibility because the reporting standards are too onerous. So maybe Patrick, your thoughts on that, and then maybe Pete.
Well, look, when assessing credit risk for investment purposes, more information is obviously better than not, and most importantly, the timeliness of that information and how it affects your investment decisions. So the RBA standards is an obvious huge improvement as we move away from averages and managing credit risk on those pool averages. I think the standardised information is going to allow for much better comparison analysis, especially between the issuers. This transparency, I think, will create opportunity for people willing to take the time, given that the three RMBS issuer curves being non-bank, obviously the smaller ADIs and the big four, are trading reasonably close together. When we get more detailed information, it'll be interesting to see how that curve moves and if it does move at all. So, we're looking forward to the standardised information. Some of the parts of it that will be relevant for us will be the LMI payout ratios, timely claim information. Excess spread will also be very beneficial. I guess the downside is really not having the postcode or even the property address, especially if arrears are going to spike dramatically, but or even if the deal becomes distressed. But we do, however, understand the privacy concerns, especially with the new privacy legislation coming in. So the zones and the way that they're going to work with those zones is, we're interested to see how that's going to help us.
Sure. Pete, your thoughts?
Yeah, look, on postcodes, I think that's certainly something we see as a potential issue. I think, you know, one of the previous panellists mentioned shocks to the market, one being, you know, localised house price declines, but a second one being sort of exogenous exogenous non-market shocks, such as the Queensland floods. You know, probably allowing investors to assess the impact of those type of events is going to help liquidity in those bonds. It's going to help the issuers print deals post events such as that. So I think that you know, we can certainly make that. You know, I think there's a gap that can be bridged there. We can meet the privacy concerns and still get sufficiently granular data at a local level to be able to make good credit decisions. I think in terms of credit analysis, sort of the way I think about it on prime RMBS, you know, a big story is really the wrap. We're going to be looking at the data across, you know, multiple issuers and really understanding and trying to understand where the risk is at the LMI rather than necessarily at the individual transaction level. We get comfort on things like claims payouts and the ratios with respect to that by, you know, really meeting with the issuers on a frequent basis, understanding how they make those claims and what the operational processes are by which they interface with the mortgage insurers. For me, I sort of look to the US experience and where I see loan level reporting being of real value is during periods of distress in the market and aiding liquidity in those periods of distress. So being able to understand, you know, whether a borrower is current for, you know, just the past month or has been current for each of the past 12 months, for instance, in a deal that may be